Welcome to another episode of Financial Fortitude, the podcast that equips you with the wisdom to make sound financial decisions in a complex world. Today, we're diving into the timely topic of open enrollment for employee group benefits. With open enrollment season just around the corner, we know it can feel overwhelming to sift through all the options available. Which benefits are truly valuable, and which ones might end up costing you more than they're worth.
Whether you're looking at healthcare plans, life insurance, or even more specialized benefits like disability or legal, today we're breaking down which options offer the most bang for your buck and which ones you might want to reconsider. We'll explore how to approach these decisions from a probability perspective, ensuring you're not overspending on unlikely scenarios. So if you're ready to take control of your benefits package and make smarter financial choices, stay tuned.
Welcome to Financial Fortitude, a podcast for high earners, families, and business owners. We're your hosts, Michael Acosta
and Brady Hemmerly. Each week, we bring purpose-driven financial guidance to you so you can be assured you're on the right path. If you're looking to become an extraordinary wealth builder, let's dive in.
Brady, I'm really excited to dive into this topic because it's definitely timely as you and I are going through the throes of sifting through our new benefit options that our employers offer us or that we have access to within our financial planning practices and trying to figure out how has our life changed since the last time that we enrolled? What are some benefits that maybe I didn't opt into last go around that maybe would be more prudent to opt into this go round?
Sure. And I would agree. And I guess the first question that I have for you, and I would expect many listeners to have is, well, why is open enrollment important, whether it's the decisions they make or just simply paying enough attention to the decisions that they make?
Open enrollment's important because you're going to be locked into these benefit options for at least the next 12 months or so. And open enrollment, or what we like to refer to as open season, is typically going to occur in the fall, right? You're going to start to get your welcome packets or your employee benefit guides sometime in October, and then open enrollment's going to be within like a 7 to 10 day window sometime in November. And you're basically making decisions based on what the next 12 months might entail for you. Now, obviously, there's two types of events that occur in your life, those that are planned and those that are unplanned, right? Another way of looking at another way of looking at that is having certainties and uncertainties. And when it comes to certainties, those are things that we can easily budget for. But when there's a lot of uncertainties in the future, that's where it really makes sense to try and transfer that risk to somebody else. There's some sort of opportunity cost to say, hey, I don't know what the certainty that this is going to occur, but if it does, it could potentially be financially devastating to my financial well-being.
Sure. And I think that's where open enrollment and really the insurance conversation across the board comes into light. Because why does insurance exist, right? It's to aid and transfer those true uncertainties that clients might have to the insurance company instead of to their personal balance sheet or to their personal situation.
Right. And when it comes to open enrollment, it's not just insurance that you're opting into, right? There's retirement benefits. There might be deferred compensation options. There's a lot that goes into it, even pet insurance for those of you who have fur babies. So, it's important to just understand what's being offered because some benefits might be rolling over into the new year. Others might have dropped off depending on how the employers adjusted the overall quality of the benefit package. And costs change. Insurance costs change. The financial strength of different providers change. So it's a matter of just doing your due diligence. Also, how has my family's dynamic shifted since the last time that I enrolled? Did I go from being single to married? Did I go from it just being me and my spouse to now having a dependent or adding an additional dependent? Did I get divorced? Does my spouse now have access to employee benefits when previously they may not have, whether it been them being a homemaker or their just former employer never really offered adequate benefits? So These are all considerations that need to be discerned. And again, don't just take the digital package or the handouts or the invites to the webinars to review the employee benefits and put it into spam or file it away and never look at it again, and then rush through it when it comes time to submit it before it expires, before the window closes.
For any listeners who are tuning in now, who perhaps are listening to this not in October or November, and they are saying to themselves, well, this was great, but I now have to wait 9 or 10 months to get back into this period. Talk a little bit more as to, hey, I've already made my elections and either I need or want to make a change, or when is the next time I can make a change?
Yeah, so typically there's going to be two options for when it comes to, or I guess two categories would be the better way to phrase it. Two categories of when an individual can adjust their benefits that they've enrolled into. And these are going to be known as triggering life events. So if you change an employer, that's going to be a triggering life event where you have the option of updating the benefits that you've enrolled into, right? Because you're terminating service with one employer and joining someone else. Also, open enrollment season. So every fall when open enrollment starts up, that's going to be a period of time when you can make those adjustments. Other triggering life events would be loss of existing coverages, change in household. So again, whether you just recently got married or whether you've gotten divorced recently, or if you've added a dependent, those are triggering life events where you can go in and make modifications to the bulk, if not all of your benefit elections that you've chosen. Also, in some instances, change in residence. That could affect overall coverage depending on what type of health plan you've opted into. And if you're moving to a different area where there might not be the same level of coverage that was being offered from the previous health care or health insurance that you had opted into.
Sure. So I guess as we jump into things, when you think through open enrollment season, what oftentimes are some of the benefits that come to mind or that you see the most questions from client-wise?
Yeah, and so I like to break this out into two categories. Core benefits, these are going to be benefits that are typically going to make the most sense in just general situations. And then you have the ancillary benefits where they're more or less things that may add value, but more often than not, it might just be a sunk cost just based on probability of use or probability of payout, even if it is relatively inexpensive. So when I think of those core benefits, it's really the medical insurance. It's going to be, the medical savings plan. So flexible spending account versus health savings account. Also looking at group long-term disability and short-term disability, group term life, your retirement plans, right? So making sure that you're prudently setting money aside for the future. And one that I really like that's become more prominent over the course of the last decade would be legal advice, legal benefit, because it's a great inexpensive way of gaining access to a network of attorneys to be able to help you execute some of the things that a lot of us like to put off.
Oh, very much agree. Well, let's start with the medical insurance side of things. I think the big question often is, well, I have 3 or 4 different plans in front of me. Which one makes the most sense for me, or why should I pick A, B, or C?
That's where I think most individuals or families get hung up, because there's a couple variables that go into the overall quality of the health insurance, right? At the surface level, it really comes down to how much am I willing to self-insure versus how much am I wanting someone else to cover for me out of pocket up front. That's where you get into low deductible and high deductible plans. Another category or variable that comes into this would be HMOs versus PPOs. HMOs are typically going to be less costly compared to a PPO, typically, but the PPOs typically are going to be more flexible with available providers and who you can go see. The HMO is going to be limiting as far as how you gain access to other doctor referrals, having to have a PCP, primary care physician, and not really having much flexibility with coverage outside of network. So just think about who are the doctors you go to, what are the things that you typically do on a recurring basis annually for your health, and that should help drive you towards HMO versus PPO, aside from just the overall premiums that you're going to be paying.
Yeah. Yep. What I hear there is HMO, less costly or more cost efficient, but just the flexibility is not there. Whereas PPO is more costly or less cost efficient, but there's just way more flexibility and options, and that, hey, I need to go see a new doctor or a doctor that's out of my network or someone that I hadn't ever seen in the past before.
Correct. And so that's where I think when you're going through this decision tree, it's okay, am I going to HMO or PPO? And then from there, just right after that, it's a conversation of, well, do I want to have a low deductible or high deductible? What does that even really mean? Like, what's considered a high deductible? Well, the IRS for 2026 defines a high deductible for individuals as being $1,700 and for families being about $3,400. And there's a little bit of room for variability there. So just make sure you look at your plan documents that are being offered.
That's what I was going to say. The IRS defines high deductible as a specific number, but your plan could very much define high deductible as whatever number that they tack on there or is associated with the coverage.
Correct. And so in today's dollars, in today's society, $3,400 deductibles really not as high as one could think. But that's purely subjective because all individuals' financial circumstances are different, right? So we don't want to discount that. But what's nice about having the high deductible health plan When you really want to level up and optimize your overall decision-making process and the use of the dollars that you're earning is when you couple that high deductible health plan along with a health savings account. And we absolutely love health savings accounts because of how they're triple tax advantage. And we'll dive into that a little bit more here in a second. But when you're looking at the two, traditionally, not always, traditionally, the low deductible plan is going to be more costly from a premium perspective. So you paying for the cost of the coverage, whether it be biweekly, twice a month, once a month, whatever it is, whatever that frequency, is typically going to be more costly because the insurance provider is covering more upfront or stepping in to help cover you earlier on in a more rapid scenario. Versus the higher deductible, you as the insured are having to self-insure until you meet that deductible. Okay, so you're paying more out of pocket. And that's where it becomes a little overwhelming for clients or individuals, is because they can't see the forest through the trees because all they see is the deductible. Now, again, if we're going to leverage a health savings account, this is where you can essentially prepay your future medical expenses in a tax efficient manner. Just so that everyone is aware, there are certain things that are covered through a high deductible health plan that are also covered through a low deductible health plan where you're not having to come out of pocket. Some of those things are going to be what we call preventative care. Anything that is considered preventative care with a high deductible health plan typically is going to be covered by the health insurance. Those are going to be things like annual physicals, immunizations, routine prenatal care, and well child visits, right? So if you just had a newborn, all of your newborn visits that are on the cadence that are required are going to be covered. One thing you might want to check with your pediatrician for is if you're going in for a well visit for the child, but they're giving the mother some sort of questionnaire or something for postpartum depression, that may not be covered over the preventative care because that's technically for the mother and the preventative care in that case is for the child, right? So just be aware because we've got caught off guard by that. That's a personal experience there. So again, routine prenatal care, well child visits, screening services like cancer, heart disease, vision and hearing, and then obesity, weight loss, and a slew of other services. Now, pros, what are some pros and cons to high deductible health plans?
So the pros to high deductible health plans are often that, and you mentioned it, premiums are lower. The deductible is the cost that I or you have to come out of pocket for. And because that cost is much higher, I've got to stilt more of that burden. The premiums are lower on a biweekly basis, which is great for most of us if we're not going to the doctor often, or perhaps we just don't see regular medical costs. In those instances, I'd rather pay less for my premium than pay more. Another pro to the high deductible plan is the use of that HSA, the ability to save tax deferred into an account, see those funds continue to grow without a tax bill, and then use those funds to satisfy your deductible at some point in the future or work towards other medical costs. An additional pro is that your employer oftentimes offers benefits with that HSA or even contributions into that account, as the example. And a pro is oftentimes just the general flexibility if you're on the PPO side of things. I can go see doctors both in my network and out of my network.
Are there any cons to being in a high deductible health plan?
So cons are, and it's not a shock, right? It's the cost of that deductible. Because I am now stilting more of the medical risk or the healthcare cost risk. If a client has a surprise and needs to go to the doctor and was not otherwise expecting to, in those instances, well, I've got to come more out of pocket, or more money has to come out of my financial balance sheet to hit that deductible first before the insurance company really starts to step in. So it's more just so in those unexpected or uncertain scenarios, how much do I have to come out of pocket for the coverage? Whereas a low deductible plan, the benchmark's lower, right? I don't have to come out of pocket as much because the insurance company's sharing more of those costs.
Got you. And so one generalization that I would make is that if you're healthy and you don't frequent the doctor outside of preventative care, high deductible health plan could make a whole lot of sense. And one strategy that you might want to consider, or at least look over, would be comparing the cost and premiums of the low deductible plan and the high deductible plan, whatever that cost savings is per premium payment, trying to commit to saving that and putting it in either a flexible spending account or a health savings account, right? Because then what you're doing is you're taking that cost savings that would have been going to premiums and setting money aside for a delayed gratification to cover a qualifying medical expense in a tax efficient manner.
Yep.
Another generalization would be if you know that you're going to have a costly procedure done in a given year, you may want to go with a low deductible plan. That way you hit your deductible sooner and you're having to come out of pocket less as far as the overall cost. And you'd want to compare what the overall cost is for the health insurance on the year versus the procedure if you were to pay for that out of pocket. But then once you meet your deductible, you can go visit all the specialists you want. And a lot of the times, the bulk of it's going to be covered by the insurance, right? Which is why you see so many individuals or hear so many individuals hitting their deductible. And then now they're going and seeing everybody under the sun just to make sure that they're fully covered. But let's go ahead and segue into the next topic of flexible spending accounts and health savings accounts, right? And there's multiple types of flexible spending accounts, but the ones that we're going to focus on in this conversation is primarily going to be the medical flexible spending account or the healthcare flexible spending account compared to the health savings account.
Well, what's the allure to both the FSA and the HSA? The allure or the benefit are both are tax advantaged. What does tax advantage mean in this circumstance is if you make a contribution to an FSA or an HSA, you have the ability to deduct that expense from your overall income. Save money on taxes. The company itself, through setting up these plans, gives you an opportunity to make a tax deductible contribution, which is great. Now, an FSA works in a manner in which the maximum contribution per employee is $3,400 a year. And you can spend tax-free those FSA dollars on qualifying medical expenses. So the way that I see and hear that is, well, I can save money and not pay taxes on it. And then when it comes time to use those funds on medical expenses, I don't have to pay taxes on it.
Well, that sounds almost too good to be true. Why wouldn't everybody use the FSA and just go ahead and try to defer $3,400 per year?
So that is where the primary difference between the FSA and the HSA comes into place or into play. And it is that the FSA functions as a use it or lose it type of account. And what that essentially means is, hey, I've saved my $3,400. I'm ready and I've built that buffer up to help pay some of my deductible. But great news, surprise this year, I don't have any expenses to pay. If in the event that I don't have any qualifying medical expenses, I don't get to use or I lose those funds.
Got you. And just to clarify, the 2026 limits for contributions per employee to the FSA is going to be $3,400, and the carryover, or what you're allowed to roll over into the next enrollment year, is about $680. So just to give an example, let's just say you put $3,400 in at the start of the period or over the course of the 12 months for that year of coverage, but you only use $1,000 worth of your FSA. Well, now you're going to end up losing a pretty sizable amount because only up to $680 is going to roll over. And that's not something you want, even if you're getting a tax deduction, because those are otherwise dollars that you could have utilized at a later date for a qualifying medical expense. Now, how does that compare to the HSA? What do those limits look like, and what are the overall rules of engagement with it?
So HSA, very similar in that it's tax advantaged, right? I don't pay income tax on the contribution that I make to my HSA. Now, the IRS limits in 2026 for an HSA per individual is $4,400. And for a family, if your spouse is enrolled in the healthcare plan alongside of you, is $8,750. So again, the benefits are tax advantaged on the front end. The additional benefit is any growth, because you can invest in an HSA. Right? Any growth that you see over time is tax advantaged in that I don't pay taxes on the earnings or the gains that I see within the account. And then the last advantage, similar to the FSA, is if I use those funds for a qualifying health expense, tax-free. It comes out of the account, triple tax advantage.
Well, everyone's got to love that. And I know you're going to go ahead and tell me that the biggest benefit to this is that 100% of it rolls over, right?
Yep. And that's the benefit, right? Hey, I save my $4,400, my $3,400, whatever that number is per year. And oh, by the way, I'm not rushing or scrambling to go figure out where to spend this money before I use it. I can just keep rolling it over, saving and investing for the future.
Yeah, and that's where you're not forced to go to the pharmacy and just start buying things that qualify, like, Band-Aids and bandages and everything else, and now you're putting it all in your pantry and it's just taking up space so that you don't lose those dollars in the FSA. Now, what's really neat, just to give an example, is that if I'm 30 years old, or let's just say I'm 35, and I plan on working another 30 years, that's going to take me to age 65. If I maximize the utilization of my HSA and I just put $4,150 a year into that HSA, and let's just say I don't use a dime of it because I'm healthy for those 30 years. Probably very unlikely, but let's just roll with it. And let's just say that the contribution amount increases annually by 3% cost of living adjustment for the amount that the IRS allows us to defer into an HSA. And let's say we start investing that. And let's say we average over the course of 30 years an 8% net return. When I get into retirement, when I decide to exit the workforce and head into my glory years of living off of a fixed income, I now have, at a minimum, close to $684,000 in a triple tax advantaged bucket, where I can use this now during a period of time where I'm probably going to have increased expenses for medical care, whether it's going and seeing more specialists on a recurring basis. Because as much as it stinks, as human beings, as we get older, our overall health is subject to decay.
Oh, certainly. Yep. That's where most medical costs in the United States are found, right? It's individuals over 50, over 60 years old who have lived healthy lives, and then they start to slow down, right? I think most of us have parents or grandparents that we've seen medical costs ramp up later rather than earlier. So getting those tax benefits early can help as you build wealth, and then receiving or seeing those tax benefits later when you actually go to spend your wealth is a huge benefit.
So just so everyone's aware, it's encouraged that depending on which account you enroll in, whether it's the FSA versus the HSA, that you look at what are the qualifying medical expenses that you can spend these dollars on in a tax efficient manner, right? Some high level examples would be deductible payments from doctor's visits, prescriptions, hearing aids, long-term care premiums, which again is huge if you can proactively set funds aside in a triple tax advantage manner. Insulin, as well as contact lenses, glasses, so on and so forth. So again, just look at the list, see what's been added or excluded from years past, and make sure that you're setting yourself up for success with triple tax advantage dollars. One thing that I will add is that if you can utilize the health savings account along with your pre-tax retirement contributions, your deferred contributions, this is an excellent and powerful tool to improve your overall student loan forgiveness strategy. So go back and listen to our previous episode where we talked about maximizing your student loan forgiveness as a graduating medical student, or anyone who has federal student loans and qualifies for public service loan forgiveness or time-based forgiveness. Being able to defer more and reduce your adjusted gross income is really going to help you.
So let's summarize there. What I'm hearing is, once we've decided what flexibility looks like or what flexibility someone's looking for, the next place in determining, well, do I go low deductible or high deductible? What are things to think about? Thoughts there are, over the course of the next year or until my next life change, what type of medical expenses am I expecting? If I'm expecting a lot of medical expenses, or perhaps have a planned procedure, low deductible might make more sense. I know I'm going to spend that money. Whereas someone who is not expecting medical expenses or has rarely seen medical expenses in the past, a high deductible plan may make more sense for that person. And then in addition to that, the next thought is, well, from an uncertainty perspective, what happens if I have a surprise or an uncertain event that comes and kind of shocks my world? The thought there is, well, do I have the financial strength in my balance sheet to cover the deductible? And how is that going to affect my overall financial plan or my day-to-day? For clients who don't have as much liquidity, who are really working on saving their emergency fund, a low deductible plan might prevent really high-risk, disastrous financial circumstances. Or for clients who have strong liquidity, who have a strong emergency fund, who have even perhaps an HSA that they've been using in the past, continuing to use or using a high deductible plan might be best.
Absolutely. Absolutely. Now, continuing on with some of these core benefits that we think are worth looking at, or at least considering, group long-term disability and short-term disability. I'm not going to spend a ton of time here just because we had an entire episode back on episode 6 entitled Protecting Your Greatest and Biggest Asset. Short-term disability is something that's often overlooked, especially among young, healthy professionals. It's highly encouraged that professionals opt into short-term disability. Typically, it's going to cover you up to about 180 days in the event something happens, right? But where it's most powerful and where we see it come up most frequently is for maternity leave. A young professional gets pregnant and they deliver the child, and now they want to be able to replace a percentage of their income while they're at home with that child. Typically, it's going to be about 6 weeks. In some instances, it could be 8 if you buy up. So it's encouraged that you get the short-term disability. A lot of times that might even be covered by your employer. So it's free. Definitely consider opting into that. On the long-term disability side, consider opting into it as well. There's typically going to be a basic option as well as a buy-up option. More often than not, the basic option is adequate, at least on the surface level, to get a baseline of coverage that's going to replace a percentage of your income. More often than not, group coverage is going to replace 60% of your gross earnings. But you have to make sure that you confirm, is it my base salary or base salary plus incentive comp or base salary plus commissions? Because you want to make sure that you know exactly what's going to be replaced. Now, it's also encouraged that you supplement a group long-term disability policy with a personal policy only because of the differences in tax advantages when you receive the benefit. If your employer is paying any of the premiums on the disability coverage at the time of claim, if you ever have to use it, that benefit is going to be considered taxable. Another big consideration is that with personal coverage, the definition of what it means to be considered totally disabled is much stronger. It's typically true on occupation. A lot of the times it'll offer the flexibility to go work in a different occupation and still receive your benefit from the personal policy, whereas the group coverage doesn't have such a strong definition.
Yep. No, super important. And again, reference back to episode 6 for more details there. Let's talk about group life, because it's very frequent that clients are asking us, should I opt in? How much should I opt into? There's this other thing called AD&D. What does that all mean? Talk to us about what are considerations to make here without just checking the boxes.
Yeah, a lot of the times group term life is going to be offered. It's either going to be 1x your salary, 2x your salary, 3x your salary, up to a cap. Most often we'll see it's going to be anywhere from 1 to 3x your salary, capped at about $500,000. If you go over a certain threshold in group term life, then the cost of the coverage starts to become taxable to you as the insured, whatever you're opting into. A lot of employers will offer basic group term life, in some instances $50,000 or 1x your base salary at no cost to you. Again, a great freebie. Go ahead and opt into it, because
if it's free, it's for me, right?
Yeah, if it's free, it's for me. A lot of the times, not always, right? You can't. There needs to be an exception to the rule there. No, but in all seriousness, it's a great way to have some death benefit tied to you, protecting you and your family in the event you don't come home one day. The good thing about group benefits is that very limited underwriting requirements, whether it's the disability coverage or the life insurance coverage. So if you're someone who's unhealthy, we want to load up on as much term life insurance as we possibly can, because we know it's going to be either very costly or very difficult to get approved out in the marketplace, where it's more customized and catered to the individual. Again, there are going to be limitations in how much coverage you can get in just the basic group coverage. They may offer supplemental. Some of those may require underwriting. You would just have to look at the situation. If you're healthy and you're younger, maximizing the freebie group term insurance and coupling it with a portable personal policy would be more efficient, in my opinion, and more purposeful, because then you don't have to worry about, if you change your job, if you get let go, losing that coverage. It follows you wherever you go, and you can lock in those rates fixed based on your quality of health versus the quality of the health of the group of the insureds at the employer for the next 15, 20, or 30 years.
And I think that's something worth noting, Michael, because what we oftentimes see, and is very much hidden in some circumstances, is group life oftentimes looks or feels cost efficient on the surface, but the costs are graded in that as you get older or as you step into older age bands, the cost of group life insurance gets more expensive. So for a young person, consistently rebuying group coverage you end up feeling an increase in cost over time, and you don't have that portability, or you don't have that true control. Whereas someone who is older in that instance, they are in a higher priced band, but it's oftentimes more difficult to get additional coverage if you're older, if you're unhealthy, if you've had a medical condition in the past.
Not only that, but I've witnessed firsthand where a client who's in an older age group, an older age band, their premiums for the group coverage was going up, and the amount of coverage was being reduced. So instead of having 100% coverage of whatever the amount that was being allotted, they're only going to get 65% of the coverage. And that's during a period of time when it's probably more desirable, right? Because of where they're at in their working career and just overall life journey. So again, when you're looking at that, just consider where you're at, what your family needs are, what the plan is in the event that you or a loved one don't come home one day, and what you want the family dynamic to look like moving forward, going from 2 spouses to 1. Shifting gears, let's talk about retirement plans. We're not going to spend a ton of time here because this is an entire episode in itself, right? Or maybe even multiple episodes. But this is also where a lot of people want to spend their time, because saving for retirement is exciting, right? That's where the returns come from. That's where the market excitement comes from. And that's where your future spending is going to come from. There's different types of retirement plans that most employers will provide. A lot of times you may have all of them. You'll have a combination. It depends if you work in the public service sector versus the private sector. And so typically you're going to see 401ks, 403bs, 401as, and 457 plans. So let's just focus primarily on the 401ks and 403bs for the time being. More often than not, you're going to have an opportunity to max that out. And there's certain limits. So definitely refer to the IRS tables on what the limits are for someone who's under the age of 50 versus someone who's over the age of 50. You get a catch-up provision if you're over the age of 50 so that you can defer a little bit more. Most plans today are optimized to allow pre-tax contributions as well as or the option for Roth contributions. And just keep in mind, Roth 401ks, Roth 403bs do not have income phase-out limits like individual Roth IRAs do. So you can still contribute to those even if you make too much money to contribute to an individual Roth IRA. The question that often comes up is, well, should I be Rothing or should I be pre-taxing? What are your thoughts on that?
So it's an interesting question, right? Because at the end of the day, a lot of the certainties or perhaps uncertainties in how to answer this question oftentimes are based on unknown tax rules or tax rates later. So for the majority of the time, for individuals who are early in their careers, just getting started, in objectively a lower or the lower end of the income tax brackets, it makes sense to consider a Roth IRA as opposed to a pre-tax IRA. I'm going to pay low taxes now. I'm going to see tax-free growth until retirement, and then retirement tax-free. That's what we'd all love. Now, in instances where I'm a high earner, in instances where I'm working on a student loan plan of some kind and I'm trying to reduce my current income, pre-tax oftentimes may be a better choice to consider because, well, hey, I'm paying less taxes now or writing them off, getting that tax-deferred growth, and then later I'm paying taxes, but perhaps at a less marginal or less effective rate. So I think oftentimes the benchmark that we use to at least begin to make that type of guidance is if your effective rate is somewhere at or around the 20 to 22% mark, it makes a lot of sense to consider Roth. If your effective rate, you're in a higher tax bracket now and all of your income is getting taxed at more than that 20 or 22%, it's time to have a conversation with a tax professional to consider, hey, just a pre-tax contribution makes sense here.
Correct. And again, the effective tax rate is going to be the weighted average of the actual taxes you paid in that given year, as opposed to the marginal tax rates being the IRS tax brackets for someone who's single versus married filing jointly versus married filing separately, and having those different breakpoints based on the level of income you're earning and then being taxed at different amounts. When you're enrolling into your retirement plan, typically what we'll recommend initially is, hey, let's just go ahead and contribute up to whatever the employer will match so that we're not foregoing any sort of quote unquote free money. Now, the reason why I say quote unquote is because the free money that they're offering is typically going to be tied to a vesting schedule. So if you're new at a job and let's just say it's a 5-year vesting schedule and you leave in year 2, you're not getting 100% of whatever your employer matched. You're only going to get probably 20 or 40% of that. So just be considerate of that, because you also need to make sure that you're saving in the right areas outside of your retirement plan, because any dollar you put into a 401k is quote unquote locked up until age 59 and a half at the earliest, or you're going to be hit with penalties, 10% early withdrawal penalty. And depending on the tax registration of it, pre-tax versus Roth, there could be some ordinary taxes with that as well. So again, just make sure that you have some optimal asset diversification as far as where you're putting your money from an annual savings rate perspective, right? Because we all want to strive to become extraordinary wealth builders.
And ultimately, that's where the benefit of an employer-sponsored retirement plan comes from. Benefit one, it gives you the opportunity to pick and choose at larger dollar amounts how to save from a tax perspective. Benefit number two, if it's free, it's for me, it's the match, right? I love taking advantage of a free contribution that I don't have to make or I don't have to save on my behalf. But at the end of the day, this benefit looks, feels oftentimes shiny, flashy, something that a young professional has to do. But if we look under the hood and say, well, hey, from a savings perspective, I need to make sure that I'm saving for my short-term goals alongside of my long-term goals. Hey, from a matching perspective, I might not see all of this money. It's about really weighing, well, how much is important here? And we'll go into more of that, I'm sure, on future episodes.
The last core benefit that I really like, and I mentioned this early on in the conversation today, was the legal benefit. This is a great way to gain access to a network of attorneys in your local area or even nationally to where you can reach out, you can vet them. And then if you need to get your legal documents in order, because that's usually something that most of us will drag our feet on and not even think about, you can get it implemented typically at a reduced cost versus if you were to go to a boutique family office somewhere locally. Now, there's pros and cons to each. Usually, if you're going to be in a boutique office locally, there's going to be more of a white glove service, more personalization to it, more of a personal relationship versus going into this network of other attorneys. You may not get the same quality of care. Now, the other things that you can use this benefit for would be if you were purchasing a home and you need a closing attorney, you can go to this network. If you are purchasing a brand new car and you want somebody to review the contract for you, you can go to this network. So there are multiple benefits to having this at a reduced cost. And if you decide you don't need it the next year because you're not having a life event that warrants it, then you can drop it. Just don't re-enroll into it. But you do have that flexibility.
Well, Michael, at this point, we've talked through all of the benefits that you and I would consider most important when running through open enrollment. I think all that's left is really just to review what benefits to individuals perhaps reconsider or maybe not even select because they might not be worth it. I think the biggest one or the questions that we get most often up front are on child life insurance or life insurance for dependents. Talk a little bit about that.
It's oftentimes even beyond that, right? Because some employers offer really robust benefit packages, and it can be so great to have all these options to choose from. And sometimes we just enroll in things that don't necessarily really add much value. And one of the things that you mentioned specifically would be voluntary life insurance for dependents. Typically children, you could also get it for your spouse. And I would say it's somewhat hand in hand. And to be overly just transparent, these are our opinions, not necessarily direct recommendations. So if you feel otherwise, that's perfectly fine. You need to do what you feel is in the best interest of you and your family. But when it comes to voluntary life insurance for a dependent, most of us as parents have an expectation that our children are going to live a long life. We want them to live longer than us. And with these benefits, they're very inexpensive. You might spend, somewhere between $5 to $10 a year for about $10,000 in death benefit on a child. Very inexpensive. And so the question really becomes, do we go and do that? Or do we look at putting those dollars to a higher and better use? Like, what if instead we went and we dedicated $25 a month towards a permanent life insurance policy that's going to be there for the life of the child with the expectation that this child is going to live well into their 70 plus years. And it's a different conversation for a different day to talk about permanent life insurance for children. And not everybody's going to love that comment, but it is something to consider because there's more value there versus something like a dependent life insurance policy through your employer.
Sure. More net positive value, right? When thinking through the scope of where your dollars are going. Additional coverage that we see oftentimes is vision and dental. Oftentimes from an open enrollment standpoint, these are pretty basic, right? You don't have a lot of options. There aren't a ton of choices. We do think it's very important that clients have dental insurance, vision insurance, especially if they do suspect to have any dental needs or vision needs through the year.
And I would even say that it's important to discern where are you at financially, because you might not opt into dental care. Maybe you're someone who has perfect teeth, very limited needs and going to the dentist aside from maybe one cleaning a year, which you might negotiate that price with your dentist if you're not going to have the dental insurance. But if you have an accident, you knock one of your teeth out, you need a root canal, whatever, you don't have the insurance, that's where it can become overly expensive on your cash flow. So if you haven't prepared efficiently and created enough of an emergency fund or enough liquidity on your balance sheet that you can access to cover an unexpected life event, then that's where having the insurance comes into play, right? It goes back to that conversation of, for things that are typically unpredictable or that there's high uncertainties around, you typically want to ensure that for things that there are certainties around and that are predictable, you can budget for. Another thing is, if you're a young family and you have children, you probably don't need to have the children on the dental care or on the dental insurance for the first couple of years, right? At least until their teeth come in. So just keep that in mind as well. Same thing with vision, right? And these are things that are often overlooked, or often we just think, hey, we need to go ahead and enroll because we now have a child. But more often than not, it's not the case that you're going to utilize it for the children, at least until they're a little bit older, maybe 3, 4, or 5. And again, the teeth start coming in, and maybe the doctor, the pediatrician, actually identifies that the child has some sort of stigmatism or something going on with their eyes that warrants the coverage or going and seeing a specialist. Another benefit that clients are eager to enroll in is accidental death and dismemberment insurance. And I don't know if everyone who enrolls in it truly understands how it operates, how it works, what the real benefit is. But my opinion on the matter is that with accidental death and dismemberment, unless you're within a specific occupation or working sector, it can really provide a false sense of security for you and your family.
Let's focus there, or at least bring some additional light there, is if we think through what is accidental death and dismemberment, it is a form of insurance that pays out to your family members if your passing results in you accidentally being killed or losing certain body parts when you die. It's a much more limited form of life insurance. And I think that's where the false sense of security comes in is, well, hey, I've got $500,000, $1 million worth of AD&D coverage. I'm covered in all circumstances, right? And for certain circumstances, you most certainly have stronger coverage. But for many other circumstances, that coverage is limited, and a lot of families find themselves unprotected at that point.
And it's usually they're finding out that they're underprotected or unprotected during a time of grieving, anxiety, and stress, maybe even anger for someone who's going through that grieving process, right? A loved one just passed away and you're banking on 1x, 2x, 3x their salary being paid out through this AD&D policy. And in the grand scheme of things, they're getting none of it because they didn't meet the stipulations and requirement with what would trigger a successful payout of this benefit, right? As an example of one of the criterias, if you're working on the job and you have a heart attack, typically that's going to be excluded from an AD&D policy due to it being considered a natural cause of death. And that information was pulled from the National Center for Health Statistics, right? And also pulled from that same site. If we look at the top 3 deaths that occurred or causes of death in 2022, the top 3: heart disease, cancer, and unintentional injuries. So the probability of the top 3 actually being paid out because of accidental death and dismemberment, in my opinion, very low. And again, going back to that leads to a false sense of security and understanding that AD&D insurance is not life insurance.
Yep. So what's the solution there for clients who are now realizing, hey, I might be underprotected, or this coverage just isn't as broad as I otherwise expected it to be?
An alternative would be doing your due diligence and homework and going out and looking for personal coverages around life insurance, right? And we've talked about this on the first half of today's episode. Life insurance is more cut and dry as far as the contract language and what you're getting into agreement with any sort of insurance carrier. The way that I explain it often is that it's more concise in the sense that if you die, then there's a high probability that it's going to pay out because it's based on the insured's life. Right. And there's more that goes into it. I'm oversimplifying it because there are some exclusionary things within like the first 2 years that I'm not going to get into great details about. But it's worth at least going out into the marketplace and doing your own due diligence and research to figure out, does it make more sense for me to have life insurance as opposed to additional AD&D insurance? Now, if you work within a specific sector, let's just say you work in a hospital system, or you're a police officer, or you're in the military, or you're a firefighter, or you're an EMT, there is a higher probability for you that AD&D might pay out because of the line of work that you're in. So if you're in one of those sectors and it's very inexpensive, which traditionally AD&D insurance, either at a basic level or even a supplemental level, is going to be very low costing. If you feel like it's prudent for you to have it, you need to do what you feel is in the best interest of you and your family.
So, Michael, as we work towards wrapping up our episode today here on open enrollment, let's talk through a few common mistakes that we often see year over year that clients are making and an easy way or easy ways to avoid those mistakes.
I would say the biggest mistake that we come across is just automatically renewing or re-enrolling into the exact same benefits that you had done previously. And typically what will lead into that is procrastinating and waiting to the last day to actually complete your open enrollment benefit elections and then feeling almost handcuffed into making that decision. They typically will give you maybe a week, 2 weeks, and give you all the information about a month in advance. This is a period of time where if you're working with a financial advisor, this is a great opportunity for you to send them your benefit guide and the cost summaries so that they can at least compare and contrast what you opted into last year as well as where your life is today. Did you add a new dependent? Did the wife who might have been a homemaker go back into the workforce? And so now we have 2 benefit packages to look at, right? Or maybe even the stay-at-home dads that went back into the workforce.
Yep. And then there's just simply additional risks in, well, how has my life changed since I've last made the benefit elections? And what might my life look like over the course of the next year? Renewing what was a high deductible, low cost plan in a year where you're not expecting expenses is much different than renewing a high deductible, low cost plan when, hey, I've got a few elective surgeries that I've got scheduled already coming up in the next year.
Correct. And it even goes even further to build off of what you just mentioned. How has my life changed in the sense that, am I still just as healthy as I was the year prior?
Yep.
Because if I'm someone who maybe had a negative life event from a health perspective, maybe I had a health scare, how has that impacted my insurability as an individual in the private marketplace? The private marketplace can be more competitive with how the strength of coverage is going to be designed in favor of the individual as opposed to sharing and pulling the risk across a large group of employees. So if you're now no longer insurable because of a health scare, maybe now's the time to increase the amount of both basic employer group options plus the voluntary options specific to the life insurance and the AD&D.
Yep. No, totally agree there. I think another big thing that we oftentimes see is just really what is underestimating costs or just over-insuring. It's very frequent that we see clients elect into or automatically renew their coverage without really comparing costs or understanding, well, what am I giving up by making these elections or paying for these benefits? And an easy way to consider a look at that is overinsurance, right? For clients who, as an example, do not have any scheduled medical procedures, for clients who are generally quite healthy, and for clients who have a good emergency fund built, is purchasing into or electing into the lowest deductible, highest cost plan best for them? In many cases, no, right? You're overpaying for insurance that you otherwise don't need.
Right. And I would even say that it goes a little bit further from a psychological standpoint, that it's more behavioral than anything else because of maybe a fear of the unknown, right? Well, what if I do have to go visit the doctor unscheduled, right? That's not considered a preventative appointment or preventative care. And I then get a large bill because I didn't have that low deductible plan when I was previously responsible for just paying a copay.
Yep.
This is where if you build the disciplined habits of increasing what you're saving, that comes from the cost savings from being in a cheaper health insurance plan. This is where you're prepaying yourself for any future unexpected medical event that might occur, at least until you meet or satisfy your deductible.
Yep. And that almost leads perfectly into the last major mistake that we see in how clients overlook their open enrollment options. It's just ignoring the HSA, the FSA, the savings options that are awarded to individuals by participating in certain plans.
And I would even add to that from a different vantage point that if you and your spouse are going to be on different medical plans, you then have to make sure that you're on the same page with which type of health or medical savings account that you're going to opt into, or else you're going to do the opposite of getting tax advantages. You're going to get hit with tax penalties. And we've talked about this a little bit early on in this episode. So if you are given the option for a health savings account or flexible spending account, I think it should be considered as something that could complement your overall annual savings goals as well as your overall tax reduction strategies. And this is where working with a trusted financial advisor and CPA could be beneficial for you long term. Now, as we wrap up today's episode, I think we've provided a lot of insights and considerations now that we're in the middle of open enrollment season. If you were going to summarize this in a couple sentences, what do you think the biggest takeaway or at least action item is for all of our listeners?
The biggest takeaways that I have, at least from today's conversation and through the conversations that we typically have with clients, is to try to just have the best possible understanding of what their core benefit package looks like, right? What are the most important benefits that you really need to dig into? What are benefits that you don't need to spend too much time on? And then from there, it's coordinating the benefit elections that you're making based on what your financial situation looks like and the comforts that you and your family have for or with risk, right? And by coordinating what your core benefits look like with what your financial situation looks like, the path to what's best for me is going to become more clear. And then at the end of the day, the true effort or action is going to be to consistently check in with how is this plan serving me through the year? And every time that next open enrollment season comes, to reevaluate how has my life changed? How has my benefits package changed? And what new elections may be best for me to consider opting into?
Great. I love it. And I will reiterate, if you're working with a financial advisor, you should be pinging them, giving them the information as to how your benefits have changed so that you can then be guided towards the most efficient options based on where your life is at in that given moment in time.
So if you found this episode helpful, please like, subscribe wherever you listen to podcasts. Also be sure to share it with friends, family, and colleagues. And for more valuable insights, visit us at www.genesiswealthplanning.com/podcast. Thank you for joining us this week on the Financial Fortitude Podcast. We hope you enjoyed the show and learned something along the way.
If you're looking for financial guidance that is personalized to your specific needs, we're here to help. Visit us at www.genesiswealthplanning.com to book a complimentary consultation.
That's it for today. Make sure you subscribe so you don't miss out on future episodes. And as always, please share with others you feel could benefit from the show. See you next time.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Genesis Wealth Planning LLC, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. All scenarios and names mentioned herein are purely fictional and have been created solely for educational purposes. Any resemblance to existing situations, persons, or fictional characters is coincidental. The information presented should not be used as the basis for any specific investment advice. Michael Acosta and Brady are registered representatives and financial advisors of Park Avenue Securities, LLC, PAS. Securities, products, and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Consolidated Planning Group, Inc. and Genesis Wealth Planning, LLC are not affiliates or subsidiaries of Park Avenue Securities or Guardian. Michael Acosta's California Insurance License Number 0M50974 and Brady Hemmerly's California Insurance License Number 4353077 7237198.21 expiration 1027.